thanks. It's got a little red record right there.
Gotcha.
Okay. All right. Let's go through this. All right. So is everybody getting the videos and everything? And remember, there's a lot of stuff that you guys need to focus on this third of the class. Okay. And then once we get through the quiz, we'll do most of the problems for the midterm, and then again it shrinks up. Okay. So I'm kind of pushing you at the front of the class, and then I'm going to give you back at the end of the class when when you're stressed out on your other classes. Okay. And I do just a little note. I do throw a little party at the end of the semester at the where is it usually? Oh, the Metro. Usually like that Thursday, the last day of finals and stuff. I usually run it from like 2 to 4, something like that. So you guys are all invited. Burger, beer, all that stuff. It's really fun. I don't know if you've heard about it, but it's a great event. So you guys are all invited. Yeah. I did it there because they have parking there. Where some of the other places don't have parking. Okay, so you're getting the videos, the market updates. We should do the market updates really quickly. I mean, like super fast, because we got to do the other stuff. So where's the down trading right now? Europe came out last night, aggressively cut their interest rates to stimulate the economy, and China did the exact same thing last week or 2 weeks. So the global economy is falling into a recession, and the central bankers are moving to do some pretty aggressive monetary policy adjustments. So where's the down? 25. Is it up or down?
Down 60.
Down 60. Anything else other than the European news? Okay. Where's oil trading right now? Per barrel.
56.
Okay, that's fine, but I need to know the level because we trade on a technical basis. So we need to know what it's up to, by how much, and why.
It's 56.72.
Okay.
Yeah,
You're just giving me a number. So.
Is it still like the Saudi Arabia, how like you're not producing as much, so we're producing more?
Potentially, you have to read the news. Okay, usually when you look up the numbers, they're going to give news. I mean, everybody's tracking these things. There's always news. Everybody's trading them. So if you can dig in and see if you can find anything, you can probably even Google it and find the news. You can go to Yahoo Finance and find the level. Okay, so it's either going to be 2 factors, right, that's driving prices up. It's either Saudi Arabia pulling back on production or taking out Venezuela and taking out Iran's production, or it's increased demand, although we're not hearing that. So just kind of think about that. But that was great. Anything else? Okay, what about gold per ounce? Where's it been trading? Again, this is going to be on the exam. Where's gold been trading? Where's it trading? Where's it been trading? You need to memorize this stuff.
$1,285.
Yeah, is it up or down?
Down.
Okay, what would drive the price of gold down? What would drive the price of gold down? What is gold? Why do people buy it? Yeah, so what does it track?
GDP.
Yeah, probably tracks GDP to a certain degree based on inflation. Who said inflation? Great. So is inflation expectations going up or down? And gold's going down.
Down.
If gold is going down, are inflation expectations going up or down? Down. Okay. And if gold is down, what does that tell you about geopolitical risk? It's also down. Excellent. Where's the 10-year treasury yield right now? Where's it yielding? You should be on Yahoo Finance. Are you looking at Yahoo Finance? You all should be.
It's down.
Hold on. You all should be on your computers digging around for the information. I see your hands in your pockets. Your hands are in your pockets.
I have it.
Okay, perfect. So what's the 10-year treasury yield?
2.64.
Is it up or down?
Down.
Excellent. And using the Fisher equation, what would drive nominal interest rates on the 10-year treasury down? Using the Fisher equation. What would cause the nominal interest rates to go down? Again, you should be like flipping through your notes, looking for the Fisher equation, and looking and answering the question. The top students in my class take copious previous notes, and when I ask questions, they go through the notes, and they find the answer, and give me the answer, within literally like 3 seconds.
Inflation?
What?
Inflation?
Is it inflation or inflation expectation?
Inflation expectation.
Excellent. Where is the US dollar to the euro and US dollar to the pound?
So the euro is down, it's at 1.12.
So if it's down 1.12, did the dollar appreciate or depreciate? You need to focus. If it's down, did the dollar appreciate or depreciate? Appreciated. And what did the euro do? Depreciated. Excellent. What's going on with the dollar to the pound?
The dollar appreciated.
Dollar appreciated. Yeah, there's problems, right, with the Brexit deal, so that the pound is actually depreciating significantly against the dollar, which I think this week or maybe next week, Theresa May is going in front of Parliament again to get voted on the Brexit deal. She may be out. Okay, she's gone in front of them like many times. At some point in time, she's going to have to dissolve her administration and ask for general elections. She's done. Okay, she's done. Again, remember the supply-demand factors. When you're analyzing these markets, and you're putting together your memos and identifying the factors, think about the supply-demand factors that we went through last week in the lecture. Okay? And when you're doing your memos, you should be thinking about the supply-demand factors. And where do you think the prices are going to go, up or down, and tell me why. Give me 3 factors. What I've done is I've edited, I've given you feedback, and I've checked off most of your memos, your pre-tests, and your homeworks, okay? So you should be up to speed by now, okay? Pre-test quiz review, the last thing we're missing is the modern and the post-modern portfolio theory application, which I'll do as soon as possible. Team 1, did you do chapter 2?
Yeah.
Got it. Team 2, did you do chapter 3?
Yeah.
Okay. Team 3, did you do chapter 4?
Yeah.
Team 4, did you do chapter 5? Okay. Team 5, did you do chapter 6?
Yes. Yep.
Okay. Team 6, did you do chapter 7? Team 7, did you do chapter 8? And then team 8, did you do chapter 9?
There was no team A.
No, team 8, okay. So we're missing, what, chapter 6 and 9?
No, chapter
We're
6.
we're presenting 6 to 7.
Got it. So we're missing 2. Got it. Okay, we'll go over some of that stuff today. Quiz. Tuesday, Thursday, two parts, 2-day exam. Okay. Review sessions this Friday from 12 to 2, Galileo, 3rd floor conference room. I'll have another one. I can't do it on Monday, like I said before. I apologize. So I moved the second review session to March 13th, Galileo conference room from 12 to 2. Okay, so I'll be available if you want to come see me, set up an appointment, have me go through any of that stuff. I'll work with you on a one-on-one basis if you need that. Okay. What else? On the quiz, we went through the macroeconomic foundations of orthodox monetary policy. We went through yield curve dynamics. We went through the relationship between the S&P 500 and the yield curve. We went through economic indicators and targets. We went through the table that needs to be on the exam, which is your market updates. We went through the dynamic supply-demand analysis, the graphs and the factors that shift the supply and the demand curves out and up, and up and down. And we looked at the microeconomic foundations, financial product innovation and engineering, what are the criteria, and the environmental conditions and market conditions, and organizational conditions that need to be in place to be able to create an environment of financial product innovation. And they were actually talking about this just the other day in the news, okay, about all of this stuff. We're going to do modern portfolio theory and postmodern portfolio theory today in a multi-asset portfolio context. The derivative trades we already did. We did technical analysis. And we need to do the finance, the quiz problems, which I'll walk you through pretty quickly today. Were you guys ready to do a 10-minute presentation on chapter 7? Can you do it in 10 minutes?
Yeah.
Okay, cool. Why don't I do the do the problems, the quiz, and then I'll do the modern portfolio theory, and then we'll do the last 10 minutes of the course to do. Okay. And then here are the homework problems that we put up on the board. If we have some extra times, I'll have you take us through that, but you should have all of the problems. I just thought I'd put them up on the board. So for those who didn't finish, you know, all the problems you have, you can see what the answers are. What I want to do quickly, did anybody have any questions? What I want to do quickly is go through the last problems that are on the, can you see that? The last problems that are on the exam. Let's see. So did we go through, can you, actually I need to keep that in. Okay, I'll do it right here. So on the exam, right here on the last page, it says intrinsic valuation. Intrinsic valuation theory. Okay, and you got to put up the equations for the theories. I'm just going to write them right here. So the perpetuity approach, the cash flow T plus 1 divided by I equals the value using the perpetuity approach. That's the equation. Are you looking? Are you finding, do you have any problem finding it? And then the Gordon growth model, what I'm looking for is cash flow T plus 1 divided by I minus G equals the value using the Gordon growth model. The multiple approach is going to be the cash flow T plus 1 times the multiple T plus 1 equals the value under the multiple approach. I just want you to memorize the theory, okay, and then we'll get into the application over here. Okay, and then the discounted cash flow, I'm just going to use a two-period model. 1, 2, 1 less I to the 1 less I to the 2. Then you're going to have cash flow T plus 1 and cash flow T plus 2. Now there's two ways of doing this. You can either add the terminal value to last year's cash flow, or you can extend it and go, terminal value divided by 1 less I to the 2. So you can do it either way. I usually do it this way. I calculate the terminal value and I add it to the last year in the holding period's cash flow and then discount it back with the discount factor. Okay? And we'll go over this over and over again, but I want you to just be able to write out the theory. Okay? And then let's go through the problems on the exams really quickly. Yeah. Oh, sorry, are you still writing? So you can take a picture of that too.
Yeah. I'm sorry, I missed it. Is the TV the last thing?
That's the terminal value.
Is that part of the equation, or is that a substitute for the second CFT plus 2?
No, it's added.
Okay.
So the terminal value is added. And remember, the terminal value is you grow out the cash flow to cash flow T plus 3, and then you divide it by either I or I minus G to get the terminal value. And then you add the terminal value to the cash flow in the last year of the holding period, and then discount it back in this. I just wanted you to just see what the equation looks like, just rudimentary. Everybody get that? All right, are we ready for the next? So let's do the problems. And you have these solutions. Okay. So you have the solution. So your debt to equity ratio is going to be the debt, total assets minus total debt. It's going to be the equity. Your total, your debt is going to be $20,885,753. You got your total assets minus the total debt is going to give you the equity, and you're going to divide the debt by the equity, and that's going to give you your debt to equity ratio. Okay, and then your equity multiplier is going to be 1 plus 0.41. This is your equity multiplier. Then your EBIT, return on assets, is going to be your EBIT divided by the total assets is going to give you your total return on assets. And you're going to compare these historically, you're going to compare them to the peer group, and you're going to compare them to the industry to see how they're doing. And then your ROA, return on assets, is net income, which is here divided by the total assets. You're going to get your return on assets. So this is actually the cash flow return. It's before interest and taxes. And then this is going to be your after expenses and net of expense cash flows, which is your net income divided by total assets, which is 18.32. And then your return on equity is going to be your return on assets times the equity multiplier, and you're going to get the return on equity, which is the #1 metric that we look at when we're shareholders, when we're buying the stock. Okay? This is plugging. And then the next problem, the present value equation. These are basically the three options. Eric Fisher, the #1 draft pick of the Kansas City Chiefs, and his agent are evaluating 3 contract options. Each option offers a signing bonus and a series of payments over the life of the contract. Fisher uses a 10.25% rate of return, that's the discount rate, to evaluate his contracts. Given the cash flows of each option, which one would he choose? Okay, so you already got the inputs. What's the solution? So you look at the contract option first. So he's going to get his signing bonus right here. So you're not going to discount that at all because that's in year 0, right up front. They're going to write him a check. And then this is the first, second, third, fourth, fifth, 6-year. It's a 6-year contract. So he gets a signing bonus. And then here are the cash flows that he's going to get in each year over the contract period. We know that his expected rate of return or required rate of return or discount rate or his cost of capital, whatever it is 10.25%. So it's going to be 1.10.25 to the 1, 1.1025 to the squared, cubed, to the 4th, to the 5th, to the 6th. These are going to be the discount factors. Then you're going to take these cash flows, you're going to divide them by the calculated discount factors, and I would like you to do that on the exam. If you could actually show me that you know how to use a financial calculator, and you can do exponential calculations to actually show me what the discount factors are here. And then when you just divide the cash flow by the discount factor, you're going to get the discounted cash flows for year 1, 2, 3, 4, 5, 6. Then you add those all up, and boom, you get 6.922. 6,922,000.
So rather than just jumping to the answer, you want us to
Yeah, totally. On everything, the homeworks, the problems. I mean, I'm giving you all the answers. It doesn't make sense to just memorize the answers and just stick them on the exam. You got to actually crank through, and write the stuff out and practice the calculator steps. Okay. I'm trying to speed up your ability to learn this stuff by giving you the solutions and walking you through them instead of struggling to figure it out. It's just you're practicing the solutions, and I think you're going to learn more from this process than just cramming for the exam and then coming in and struggling and then having to deal with the aftermath. I'd rather have you study the problems and the solutions, work through the mechanics. And that's how I got A's in all of my accounting classes and stuff like that. I went to the solutions, practice, and then came into the exam and bam, nailed it, okay? And then option B is the same, discount factors are the same, so once you calculate these factors up here, you got them down here. This is only a 4-year contract, and he's getting more money, right, in a shorter period, which obviously pushes up the present value. So the shorter the period, these discount factors are not as big, so they don't cram down the discounted cash flows. So if you can get more of your money up front, a larger bonus, which he gets, along with more money in a shorter period of time, the discount factors are less, and the present value of the cash flows are going to be higher. This is a negotiating technique, okay? So when you guys go pro, this is how you want to negotiate it. Give me as much money up front, and then give me more money over a shorter time period, okay? So the present value will be worth more. So you go through the same procedure, calculate, and you add up the discounted cash flows to get the present values. And then the last option, number C, it's over a 5-year time period. He actually gets more money up front with a signing bonus. The present value is obviously higher, so he's going to choose option C for his contract. Okay. The next question is that exactly the same. It's another contract negotiation. Trey Owens, a professional athlete, currently has a contract that will pay him a large amount in the first year of his contract and smaller amounts thereafter. He and his agent have asked the team to restructure the contract. The team, though reluctant, obliged. Tyrad and his agent came up with a counter offer. What are the present values of each of the 3 alternatives below using a 14% discount rate? Which of the 3 has the highest present value? So he came up with a, he looked at his current contract, then the team basically lowballed him, you know, on the counter offer to the current contract, and he came up with something in between, okay, which is another contract negotiation. You know, usually you come to some kind of meeting of the mind somewhere in between the 2 counter offers. You could have been going counter, you know, negotiations on a contract. Right now, we've been negotiating for about 6 months, almost a year on this contract, going back and forth. So sometimes it's easy, sometimes it's pretty hard. So we know what the cash flows are going to be. We calculate the discount factors for each of the years. We discount each year's cash flow by the discount factors. We divide the cash flows by the discount factors to get the discounted cash flows. Add them all up, boom, the current contract is worth basically 12.9, 12.8 million. Here's the team's offer for this current contract. As you can see, it was a little bit higher across the board, less upfront with more on the back end, as you can see. So these discount factors are really big, so it's going to push down the present values of these. You want more upfront and less in the back, because the discount factors are big back here compared to up here. Add those up. Here's the team's offer. So as you can see, it's over like $1 million, you know, differential. And then we as the agent, you know, counter offered the team. We were able to get more up front, you can see, and then we got less on the back end. And if you calculate the discount factors and discount the cash flows, sum up the discounted cash flows, you're going to get a counter offer of 14.5. Okay, and as you can see, it's better than all of them, so you would do the counter offer, okay, in that case. Okay, next question. Given the following information from Capstone Corp, what price does CapM predict that the company's stock will trade for 1 year from today? Assume that the risk-free rate is 3% and that the market risk premium is 8%. So we basically have the data, we got the current stock price, and we got the annual dividend. So here's the CapM equation. So So we know what the risk-free rate is, it's 3%, plus the, there's the beta, right there, 0.65, times the market risk premium, which is 8%. So you're gonna multiply these two together and add it to the risk-free rate, and you get a discount rate, or an expected equity rate of return, or equity cost of capital of 8.2%. So to calculate the stock price, or the value of the stock price, we have to solve for PI. Okay, we know what the current stock price is, we know what the dividend is, and we know what the price is. So the question here is, do you know how to do the mathematics behind it? So what I would do is I would take, okay, it doesn't give it to you here. So this is 0.082, we gotta solve for this, right? This is the, I'd like to see the algebra on this thing to see if you guys can do the algebra. So we need to isolate this, right? So the first procedure I would do is I would go 0, can you guys calculate this for me? 0.82, and I would bring this up over here and multiply it by 64.61, and that's gonna give me PI minus, and what's $64.61 negative, right? A negative 64.61 plus 1.92. So what's 64.61 minus 1.92? Negative, so you're gonna do this equation. You can do it down here, and that gives you what?
Negative 62.69.
Negative 62.69? 69, got it. And then what we're gonna do, what was this? The 0.082 times the 64.61, this one right here. What was that?
5.298.
298, got it, equals P1 minus 62. Is everybody following? Okay. And then what I do with that, I take that and I bring that over here, right? So what's 62.69, and that, what, the negative turns to a positive, right? So what's 62.69 plus 5.298? It should come up with something close to 67.99. What is it?
67.99.
67.99 equals P. Got it. Okay, does everybody understand the algebra? Does everybody understand the algebra? Could you do the algebra on the exam? Okay. So that's that one. And then 8.1 is a bond calculation. Okay. So what you need to do is you need to memorize this equation here. Okay. So we know that the maturity is 10 years. We've got a coupon rate of 8%. It's annual, so we don't need to divide or multiply anything. The current market rate is 6%. That's your discount rate. And the present, and they want you to calculate what the present value of the bond is. Okay. So the current market rate is 6%, and the coupon rate is 8%. So the question is the coupon rate higher or lower than the market rate? Is the coupon rate higher or lower than the market rate? It's higher. So if the coupon rate is higher than the market rate, is the bond going to trade at a premium, par, or a discount? If I'm getting 8% and the market's giving 6%, I'm getting 8, the market's getting 6, so my bond's going to trade at a premium. Okay, so that's the first thing I check. Okay, so obviously the bond's going to trade at a premium. Got it. And then here's the calculation here. You can do, you know, the long way here, or you can do the mathematics right here. We already know what we know what the coupon rate is, which is 80. We already got that. We already know what the discount rate is. So that's going to be what? We're going to use 6% for the I's. and then also 6% for the I. So you just plug it in, 80 times 1 minus 1 divided by 1.06 to the 10 divided by 0.06. Show me the multiplier here, plus here's the premium that you're gonna get, and you gotta discount that back to the present too, at 1.06 to the 10th power. If you run the mathematics, you're gonna get, this is the value of the coupon payments, this is the present value of the premium, and here's the present value of the bond that trades at a premium. Does everybody understand that? Let me go through it again. Yes, no? So the next one is going to test you using that equation or that equation. So the question is the yield maturity. Rudy Sandberg wants to invest in 4-year bonds that are currently priced at $868.43. Is the bond trading at a premium or a discount? When the bonds are issued, they're issued at par of $1,000. When bonds are issued, they're issued at par at $1,000. If the bond is currently valued at $868.43, is it trading at a premium or a discount?
Discount.
Paying at a discount. So is the coupon interest rate greater than, equal to, or less than the market interest rate?
Less than.
It's less than. Your market interest rate is gonna be higher than the coupon interest rate. So that's what you know. So what's the coupon interest rate right now on this bond? 6%. So the discount rate that you're gonna use to discount the bond's cash flows to get to the $868.43, is it gonna be equal to, higher than, or lower than the 6%? If it's trading at a discount and the coupon interest rate is 6%, and you gotta get to a discount, is the market interest rate, the yield maturity on the bond, less than, equal to, or higher than the 6%? If it's trading at a discount, then the market interest rate is higher, okay, than the coupon interest rate. And we know that the coupon interest rate is 6%. So what you can do is you can run the calculation using either one of these two equations, which I highly recommend you use that one. And what you do is you interpolate, okay? You could either use your financial calculate to calculate the yield to maturity, but this exercise is, do you understand if the bond's trading at a discount, that the market interest rate has to be higher than the coupon interest rate? Do you know what the coupon interest rate is? We know it's 6. So what we do is we basically plug in maybe 8% and run the calculation. Maybe put in 10% and run the calculation. So we increase the interest rate, the market rate, until we get close to the bond price. And in this case, if you plugged into this equation right here, using the cash flows that are already given to you, you're gonna have to use a 10% discount rate to get the discounted cash flows of the bonds, coupon, and the principal to the present to match the current price. Okay. The problem with this calculation too, this problem is if you're using this equation, you're going to have to take the coupon here, the coupon interest rate here is actually 3%. So basically your coupon payment, you're going to have to use $30. And the interest rate that you're using is going to have to be 3%, And because the, hold on a second, sorry about that. Oops, I'm doing kind of the math here. So I take the 6% divided by 2, that gives me the 3% times the principal. It's gonna give me $30, that's gonna be my cumulative payment. The bond pays twice per year, it's semi-annual, okay? So you're gonna have to take it's a 4-year bond, you're gonna have to multiply it by 2 to get 8 periods, okay? So now we're doing the adjustments. Now it's a discount. Now what we do is we plug those numbers in, and I would just go ahead and just plug in the 10% so you can see how the math is. So you're gonna be using 30 here, you're gonna be using 3% here, and we know that the total time period is gonna be 8. So you're gonna have to put the 8 right here, and you're gonna have to use 8 there. Okay, so you just use this equation to adjust it. I just want to see if you can do the mathematics, okay? Is everybody clear on that one? That's probably the hardest one on the exam. Yes.
What exactly is the answer that you're looking for? Like, what is your answer in terms
Well, what you would have done is you would have taken that equation,
Yeah.
all right, and you would have run it at, because you know you're not going to use 6% because it's trading at a discount, because we know that the yield to maturity or the market interest rate is higher than 6. So the question really is set up for you to go, okay, interpolate, run it at 8, run it at 10, calculate the price of the bond, and raise the market rate as high as you can. Just keep taking it up until you get to the $868.43. That's really the exercise. You can do this easily in the calculator, but I would just take that equation, run it at 10%, okay, run the discount rate at 10%, semi-annual, and you'll see that you'll come up with the $868.43.
And then is the $1,000 part just the
That's
default?
that's a standard for corporate bonds.
Okay.
Okay, so all corporate bonds have a premium at $1,000. Okay, and they'll tell you if it's a $10,000 bond, then that'll be the premium. Okay, and then the second question is pretty straightforward. This is just your Gordon growth model. So you know that the dividend is $2.15. That was yesterday. It's going to grow at 5% forever. The required rate of return is 15%, and they're asking you what the bond or what the stock price is. So we know that the dividend of 2.15, and we know it's going to grow at 5%. So we grow that out. Show me the number, and then we know that the discount rate or required rate of return is 15%. We know that the cash flows are going to grow at a constant rate of 5% forever. So it's going to be 0.15 minus 0.05. And then you just work this out, and then you get the answer. I like to see the mathematics behind it. Okay, this is a few steps, but it's pretty straightforward. Okay, any questions on that? Okay. And then the last question is a little bit more in depth, but they give you everything that you need. So they basically tell you what the dividends are that are going to be paid, right, over time. So here's your dividends here, and the dividend in the last year. It also tells you so you got the dividends, right, over the 4-year holding period. The expected rate of return is 18.5%. Right, 1, 2, 3. So you got to calculate the discount factors. The last piece, here are the cash flows. Here's the dividends, but you got to calculate the terminal value, okay, or the value of the share in the last year of the holding period. So you got to calculate a price for the share in P4. So we know that the dividends are going to grow at 6% forever. So in year 4, we got to grow it out 1 more year. Show me that calculation. And then we have the discount rate, and it also tells you that the dividends are going to grow at 6% forever, so we're using Gordon growth. So we grow out this for 1 year, and then we divide that by 0.185 minus 0.06. Boom, gives us the value of the share that we would sell it for at the end of the holding period. We add that to the last year's dividend, divided by the discount factor to get the present value of the cash flows in the last year of the holding period. Then you calculate the discounted cash flow, the dividend, sum it up, and this is the value of the shares, $25.95. So show me the calculations for this, show me the discount factor, show me that, to derive it out so that you're not just going straight to the answer, you're actually showing me the mechanics behind the calculations, so you're learning the procedures. Okay? All right, any questions on this? Okay, how much time do I have? Half hour? Okay, I can do this in a half hour. Okay, so I'm going to do the next is the modern and postmodern portfolio theory. Okay? And you may at some point in time, I don't know, maybe if I motivate you enough, you may want to go on and become a professor someday. You're definitely someday going to be in a meeting and you're going to be talking about things and people are not going to understand what you're talking about because they can't see it. Okay? So you're going to have to jump up onto the whiteboard and you're going to have to start schematicing stuff out in front of the board, okay? Or the investment committee, or the senior level executives, or your programming team, your marketing team, your IT team, your finance team, your accounting team. It doesn't matter who it is. You just got to be really comfortable that when you're explaining stuff, you got to jump up onto the board. You got to start diagramming stuff, and it takes practice and practice and practice to be able to do this stuff. So the more comfortable you get in jumping up and doing this stuff, the easier it's going to be for you. Okay. All right. So let's do the modern portfolio theory. And you said I got 20 minutes. How much time? 30 minutes? Okay. So this is how I would do it. This is how I would draw it on the exam. Okay, when I come in, this is exactly how I would do it. If you do it another way, you're going to mess it up. Okay? And when I look at your, your technical analysis, and this is the hardest one on the exam for everybody. Okay? They scramble. They're not looking at the detail. They're kind of slapping it together, and they're going to be missing some points because you're not doing it exactly in this procedure. So I would practice, doing this stuff. So the first thing is we have the portfolio standard deviation of the risk of the portfolio. Okay, this is portfolio theory. Right? I already picked my stocks. Now I'm putting the stocks together into a portfolio, and then I'm actually adding other assets to the portfolio. I'm adding bonds, and real estate, and insurance, and energy assets. I'm building a multi-billion-dollar, multi-asset portfolio for an institutional investor, okay, or institutional investors, yes.
How do you add real estate to a portfolio?
I could, well, CalPERS, $1 trillion in assets under management. They basically work with a consultant that basically says all of your portfolio, you have to have 10% of your portfolio allocated to real estate. Okay, so what they'll do is they'll say, okay, we need to buy like $20 billion worth of real estate. So what we're going to do is we're going to take that $20 billion and we're going to hack it up into two $10 billion tranches. And what we're going to do is we're going to send out a request for proposal and request for qualifications to the real estate pension advisory community. And what they're going to do is they're going to respond to the RFP and the RFQ with a formal report on why we should pick them to invest in direct real estate assets in the United States over the next 2 to 4 years. And a $10 billion portfolio will probably take, I don't know, at least 10 years, to fully allocate it to $10 billion, because it's just so hard to buy real estate. So if we win the contract, JP Morgan, pension fund advisors, real estate pension fund advisors, they'll give us the $10 billion, And then what we'll do is we'll go out and we'll find office building, retail properties, apartments, industrial buildings, all over the United States. We'll underwrite them, and if they look like they're economically feasible, we'll put bids on them, and we'll buy those assets, and we'll accumulate and build a portfolio of direct real estate investment. Okay, and if you want to talk more about this, I've done that in my career. Built a bunch of portfolios.
That's pretty interesting.
It really is. It really is. It's awesome. It's awesome. So on the y-axis, you have the expected return of the portfolio. Okay. And then what I would do next is this. Origin, this is the risk-free rate. So this is your U.S. 10-year Treasury yield. Okay. This is your 10-year. That's your 10-year Treasury. Okay, T-bill. This is the yield maturity. That's the base rate. That's what you start off at. Real estate's very risky, a lot along with stocks, so we're going to have to get a higher rate of return than what I can get from a 10-year Treasury. Okay, but that's the base rate. Right now it's around 2.6 or whatever you said this morning. And then this right here, this line is called the capital allocation line. For CAL. Okay, and then what I would do is I would go right here in the middle, put a dot, and put M. M is the market basket. And I'll talk about that later. All right, and then what I would do next, and this is where everybody makes the mistakes, so this is the way I would do it. And this is really hard. This took me years to kind of figure out. I go like that, and then I would go, oops. And then I would go like that. I do that. And maybe this is like right there. And then what I would do is I would go like this and connect the two, put a dot there and put a dot right there. And then what I would do is I would take this, go down here, star, expected return, star. So this point right here, what I did was I just built a portfolio that matches the allocation of the total universe of investable assets. Okay, so that's right here. And then what I would do now is I would go like this, and like this, and I'll explain all this. But I'm really just setting it up right now. There we go, U1, U2, U3. I would put some arrows like that. And then I would go over here and go 100% stocks, and I would go 100% bonds. And I would then standard deviation, stocks, standard deviation, bonds, ER bonds, and then up here, ER stocks. That's the majority of it right there. If you can get that far, you're in really good shape. If you can do that, you nailed it. Okay? Yes.
So what was all the lines you just drew?
Yeah, I'm gonna do them right now. I'm just setting it up, okay? So this right here is called the efficient frontier, okay? This is the efficient frontier. I can basically build portfolios of stocks and bonds anywhere along what is called the efficient frontier. This is the efficient frontier. I can also build portfolios within the umbrella and anywhere on the line or in it. When I look in the universe to invest, I'm an investor. I can only invest in stuff that's available to me in the I can't invent stuff, okay? I go into the marketplace and I buy stocks, I buy bonds, I buy real estate, and I put them together as a portfolio, so I can construct them. I can't build portfolios out here. Would I want this portfolio? Low return, low risk, high return? Would I want that? Yeah. Can I get it? No, because there's nothing like that in the marketplace. So what I have to do as an investor is I have to lower my utility, okay? These are utility curves. I'm sorry, this is actually economics. You've had it in your microeconomics. This is intertemporal substitution. This is basically, you should have had some of this stuff in your micro. These are utility curves, okay? Investors want to be up here on a higher utility curve. They want a high return and they want low risk. There's nothing available in the marketplace to do it. So they have to lower their utility, okay? And what they do is they lower their utility to the point where the utility line is tangent to the capital allocation line in the efficient frontier. And the capital allocation line just basically tells you how you're allocating the portfolio between stocks, bonds, and the other assets. So we can't be up here. We have to lower our utility. Once we lower our utility to the capital allocation line in the tangency point of the efficient frontier, I can now build a portfolio. I can build a market basket. You've heard of exchange traded funds. It's a very similar concept. Okay, yes, sir.
Can you put up the efficient frontier again?
Yeah, this is the efficient frontier. So it's the one with the umbrella. Okay, and again, when I draw it out from here, like this, and then I put the capital allocation line first, then I do the efficient frontier, and then I do the utility curves and bring it down right to there. So the first thing I'm going to check is, are your utility curves tangent to the capital allocation line and the efficient frontier? The first thing, this is exactly what I'm looking for right now. And again, let me go through the definition here and it'll clarify a lot of stuff. This is the first time you've seen it. The book does a horrible job of describing this, and this is probably one of the most important concepts in corporate finance, but the book does a horrible job of describing it.
Could you just go over everything on the y-axis, everything that says over there? I can't read all of
The
it.
expected returns?
Yeah, all of that stuff all the way down.
So this is the expected return on the portfolio.
Okay.
So this is the point where we're, where we got the market basket. Here, I'm putting all my money into stocks, so I have a 100% stock portfolio. It's giving me high return, but I'm also taking on high risk.
Okay.
Over here at this other end, it's a 100% bond portfolio. The risk is extremely low, but I'm getting very low rates of return too. Okay. So that's the first thing that I set out.
Okay, and then what's all that under it with the RF and the T-bill?
This is the risk-free rate.
Okay.
Okay, which is the 10-year treasury yield,
Okay.
which is roughly like 2.6, 2.7 today. Okay, so now, if I start off here, if I'm a bond investor, or if I'm an investor, and I'm willing to take on more risk because I want more return, I can sell off my bonds and I can increase my allocation to stocks. I can do that too. I'm selling off the bonds, I'm increasing my allocation to stocks. I can move up the efficient frontier to get more return, but I'm taking on more risk. If I'm a risk-averse investor and I don't want risk, and I'm willing to take lower return, I can sell off my stock portfolio and I can increase my allocation to bonds. So I can move up and down the efficient frontier depending on who I am as an investor and what my return objectives are and my risk tolerances. You can also jump off the efficient frontier and move up the capital allocation line and get extremely high risk, but extremely high returns. How do I do that? How do I get extremely high returns, but I also am taking on extremely high risk in the process? The way you do it is you use leverage. You use margin on your stocks, or you use mortgage finance on your real estate. I'm using other people's money. So when I buy a stock, I want to buy $100,000 worth of Apple, I only got $100,000. But I can go to the brokerage firm and I can say, hey, lend me another $100,000 at 9%, Now I can buy $200,000 worth of Apple for the $100,000. So I borrowed $100,000, I have $100, now I can buy $200,000 worth of Apple. If Apple stock goes up, my rates of return go up exponentially because I've leveraged my return by using borrowed money. Same thing with real estate. I only got like $30,000 bucks. I'm going to buy a $100,000 property. I can basically put in the $30,000, borrow the other $70,000 from the bank. Now I've leveraged my position, and if the price of the property goes up, my return on equity goes up exponentially. But I'm taking on more risk, okay, in the process. Because when I take on margin and I take on mortgage, the volatility in my returns increases due to the leverage effect. Okay? So I can do that. I can also move down the efficient frontier, jump off the efficient frontier and move down the capital allocation line through the process of lending. And that's what banks do. Banks will basically, they will lend you money at some rate for some period of time, but if you default on the margin, or you default on the mortgage, on the margin, they're gonna force you to sell the securities to pay off the loan. And in real estate, they're gonna force you into foreclosure, and they're gonna take your property if you can't meet the mortgage payments. Okay? So the process of lending lowers the risk significantly because the returns are backed by the assets of the stocks in the real estate, and your expected returns are lower, significantly lower. So you're getting lower return and significantly lower risk. Okay? Those are key components. Okay? The last piece to this is, what are the portfolio allocations? Okay, historically, how am I doing on time? Okay. From 1950 to 1970, if I was a stockbroker or an investment advisor back then, there wasn't a lot of investment products that are available today, very limited. So what I would do is I would put a portfolio together for your grandparents and your great-great-grandparents, and 30%, 70% would be in bonds, and 30% would be in stock. That's how we built these target portfolios for our clients. In the 1980s, roughly the 1990s, real estate basically became institutionalized under a legislation called ERISA, which basically mandated that all private pension funds and public pension funds should have at least 10% of their total portfolios in real estate. So that mandated it. It changed the dynamics. So 60% bonds, 30% stock, and 10% direct private equity real estate. Everything adds up to 100. Then in the 90s to the 2000 period, and the company who wrote this, I did the research, was and Associates did all the mathematics around this and basically came up with these allocations and basically said you need to have 10% of your allocation in real estate. They did the research again and they said you need to have 10% of your allocation in cash value life insurance. And that basically made the banks. The banks basically institutionalized that recommendation and put permanent life insurance through mutual insurance companies on all of their senior level executives and employees within the banks, funded all of the life insurance policies and the cash values, and used the cash values in those policies as tier 1 liquid capital for the bank. So totally institutionalized life insurance. And this recommendation institutionalized life insurance on principals, particularly people at very high levels within corporations and people who are running family offices, that if they ever passed away or something happened to them, the death benefits would be injected into the estate. It would be injected into the corporations to backfill the damage that was done when those people passed away. They're going to be putting life insurance on you. They're going to be putting disability insurance on you. You're going to be extremely valuable individuals within the corporations. The corporation is not going to hire you to then have you add value and then something happened to you. They're going to hedge the risk, and they're going to put disability insurance and they're going to put life insurance on you. And if you want to go into startup companies and raise capital, 25 million here, 50 million there, you're going to need life insurance, because I'm not giving you 25 million in your startup unless I have a $25 million life insurance policy on you, at least, or at least 10, if you're insurable. So this was extremely huge in this allocation. Then in the 2000s, the allocations changed again. Okay? And this is the target allocation. This is your target allocation. This is your model portfolio. I came up with this like 10 years ago. But it was backed by research by DB. Reef. Deutsche Bank did this, and a company called Reef did this research, did the exact same analytics, and said, okay, you need to, if you're building these large institutional multi-asset portfolios, you have to have at least 10% of your allocation in alternative renewable energy. Okay. So they took from the bonds 30% stocks, 10% real estate, 10% cash value life insurance, and you should have 10% of your portfolio in alternative renewable assets. And this has been legitimized and institutionalized at the government level in the state of California that wants to be zero carbon, wants to be completely self-sufficient, off the grid and off oil within the next 10, 15 years, 20 years. So we're talking about allocations into wind, geothermal, biogas, solar. These are the assets. Okay? And why would you invest in these? These are called alternative assets. Now, this alternative asset class has become extremely popular over the last 10 to 15 years. So a lot of capital has moved into this area. Okay? These all are alternative assets. Why would you invest in alternative assets? Well, this is the most important. There's no low negative correlation in returns to stocks and bonds. So the returns that I'm getting on these assets have low, no, or negative correlation with stock and bond returns. And this is the key, this is the point that I'm looking for on the exam. This is the second most important part of this question, okay? If I invest in these alternative assets whose returns have low, no, and negative correlation with stock bond returns, what happens is the efficient frontier bows out. Actually, I'll write it down. So the efficient frontier bows out. That's what I'm looking for. The bowing out of the efficient frontier. What does that mean? Well, it means that my expected rate of return is going to go down. But my portfolio standard deviation goes down significantly more. Expected return on my portfolio. Standard deviation on my portfolio. My risk adjusted rate of return. So if I add these alternative assets to my stock bond portfolio, these alternative assets have their returns have low, no, or negative correlation with my stock bond returns. My efficient frontier bows out. My expected return goes down, but my portfolio standard deviation goes down even more, which means my risk-adjusted rate of return goes up. I'm better off as an investor.
Which one has negative correlation?
I would say they're all positively correlated. They're probably, the cash value life insurance has zero correlation.
Yeah.
The alternative renewable energies probably are somewhat positive with a low correlation. And then real estate has low correlation too, maybe a higher correlation than the rest of them. I don't think any of them have negative correlations, but they're low or no. Okay, and it bows out the efficient frontier. Reduces the expected return, but reduces the portfolio standard deviation more, which increases the risk-adjusted rate of return. Okay, and that's what I'm looking for. Here's the key to the whole thing. If I can get my client an 8% to 10% rate of return, and I can perform and get them an 8 to 10% rate of return consistently over time for the expected return, I basically lock in the expected return component. So building the portfolio through diversification, I can reduce the portfolio standard deviation and increase the risk-adjusted rate of return. If I can nail this as an investment advisor, I can double the portfolio's value in less than 10 years. And that's what they want. That's what everybody wants. Invest my money at 8 to 10% and double my portfolio in less than 10 years. So this becomes a constant. So really the value, if I can nail that, and if I can reduce the risk in the portfolio, I can increase the risk-adjusted rate of return, we win. The money just comes flowing in, okay, as a manager. Now here's the key to the whole thing. Here's another one that's extremely just amazing too. Is let's say I'm a principal, okay? I run a family office, I run a corporation, I run a bunch of nonprofits. You know, I'm probably worth 25, maybe 50 million bucks. I'm running nonprofits, I'm running corporations, I'm running startups, I'm running my family's, you know, portfolios. I got a family office. I'm worth more than the 25, 50 million dollars, right, that I'm making. I'm worth way more than that. If something happens to me, the nonprofits go down, the corporations go down, the family portfolio goes down, the startups go down. I'm worth a lot in human capital and human equity. So I got to hedge off the risk. The way I do it is I load up on the life insurance. I have to get life insurance on myself, because if I go down, I'm taking down everybody else with me. So to mitigate the damage that's due to me going away, it's the same thing with you guys. I mean, if you look at how much you guys are worth, you're worth like $4 million sitting in those seats right there, and you have no life insurance. So if something happens to you today or tomorrow, your parents get nothing. You all should have at least $1 million worth of life insurance to pay back your family for all the money that they invested in you and the time they invested in you over the last 20 years to put you through college. We do that in business for people at a certain level. And what happens is if I pass away, what happens is the estate is injected with millions of dollars to basically mitigate the damage. And the estate and everybody associated with me basically jumps onto a higher utility curve because the death benefit goes into the estate and takes out all of the debt, all of the taxes, and then the money is used to replace me 5 times over with other people to run the nonprofits, to start up companies, my corporations, and to basically handle my family office and my family's. So that is the key at the end of the day. This is advanced planning, okay? This is the way it's done, okay? How much time do I have, or is that it? Yeah, that's it. So this is it. So what I do is when I look at the exams, I go straight to this. And I look at how you guys did. I go straight to the technical analysis. I check the trades to see how you did on the trades. I look at your financial engineering and financial innovation. I try to see how much you guys have comprehended, how much you've studied. You come in, you've got 2 days. I give you the review sessions. Me and my TAs will basically look through all of your deliverables. We will give you comments and suggestions, and then we will give it back to you to basically refashion and redo and add in the detail where you may have missed. And then you resubmit it, and then I basically give everybody A's, except for maybe 2 or 3 people that need to come see me and sit down with me so I can walk them through some of the mechanics here so they understand this stuff and they can leave with the knowledge that they need to be more effective in their careers and their lives going forward. Okay, so take pictures of this stuff. If you need it, yes, sir.
Just a quick question, is there a certain number of questions on the quiz?
It's all the same thing.
It's all,
It's the same thing. I'm just testing you to see if you study, if you use the videos for review. Did you study in groups? Did you come to the review sessions? Did you take good notes? I'm just,
okay.
this part of the class is the hardest because it's the most